It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today, the man himself, the legend, the governor of Texas, Mr. Michael Becker.
Hey, Paul.
Michael, how are you?
Things are going good. It's a little wet and rainy today here in Texas, but, it's kind of the spring showers, but the apartment market's pretty hot down here and everything's going pretty good overall.
You guys just closed another transaction. What was the name of that one?
We just closed on two. One is called Oaks Marketplace, or we're about to close on one in a week or so. The other one's called Bella Vista, North Fort Worth. So we picked up 530 units between the two properties.
That's pretty good. Were those Class A, B, C, D's, Q's, F's?
One is definitely an A. We bought a deal out of lease up down just about 20 minutes south of downtown Austin in a submarket called Kyle. So it's our second property in Kyle, and that was just bought out of lease up from the developer. So it's a highly amenitized, real nice deal. We just felt like we had a good basis, and then the other one was up in North Fort Worth, and so it's kind of like what I call an A-. So it was built in 2009. And that's got quite a bit of upside in it. So we'll have to go work for it and improve the management and spend money to upgrade the units.
So a guy like you, how do you get these transactions? How do these deals come to you? Are they off markets? Are they on markets? I mean,
one was marketed, and then one was off market. So the off market was the one out of lease up. So the developer had signed a listing agreement with a broker down there, and I just transacted with that broker last year. We did what we said we were going to do. We closed on time. That seller of that transaction was pretty difficult, actually. So the broker and I had to talk all the time to kind of counteract his clients working against us a little bit. And so we kind of bonded a good relationship, and transaction was very successful. So, when that happens, I was like, what do you have next? And then he signed a listing, was about to go to market with it. And he's like, you got this window before we go to market, going to market on Tuesday. So I think we struck a deal about a week before he was going to market, and got the deal in escrow the day before he was ready to launch it. So that's kind of how we got that one. The other one was North Fort Worth. I think it's our 14th or 15th transaction with that broker, Paul. There's been a bunch of transactions. It's the third actual deal we did with the seller. So that was a pretty competitive process. And what you do is, you use whatever edges you have. We had a good, successful track record. So we're kind of the favored one, but we got the first phone call, like if you, pay this price, do these terms, when they were kind of in the best and final process. The seller chose us to kind of go to first, and lots of hard money. That's the other thing that helps. So that's how you win some of these transactions, both track record and experience, and then you got to have economic terms as well.
Hard money, how much?
We actually passed through $350. So not only did it go non-refundable, but it went from my account to the title to the seller's account. So the joke was, I think he had scheduled a trip to Vegas the next day.
So Michael Becker, he is coming up on $1 billion in closed sales. Is that right, Michael?
Yeah, I got to tally it up. We're somewhere around $1 billion in transactions as a principal, either buying or selling. So
$650 million in assets right now?
Yeah, that's right. Assets under management about $650 million as we talk today.
So you must have closed a couple and give back some money to folks. Raised over $200 million in equity. You've purchased over 7,200 units.
Yep.
And right now you own about 5,000 doors. So you're probably a good person to talk to since you're a former banker. So you've gone from being a loaner of money to being an owner of real estate. So you're probably a good person to ask this question. Michael, what's the state of the market?
Yeah. So like I said, I think everything's going pretty strong. So we'll maybe talk a little bit about maybe we'll focus a little bit more just kind of on the lending side, because the equity's there. There's an abundant amount. Seems like there's a little bit of limited supply, at least in the Dallas-Fort Worth area and the Austin area, which is where I focus on. So I'm not as worldly as maybe Paul, that loans on many, many markets. But that's kind of, it seems like lots of money and not so many deals as we talk right now. But the debt side's been interesting. So that's been kind of the biggest thing that's changed here lately. Was we start the year out, and I guess last year we're in 2019, so for 2018, Fannie Mae and Freddie Mac did not hit their cap. So what they do is, I think they each have $35 billion in cap business, so meaning, and then they have some uncapped business. So really the two ways you could become uncapped is either green, so you do some sort of energy retrofit and do some energy savings, or you have an affordable component to it. So both those qualify for either green or affordable, don't hit the cap. So last year they didn't hit their cap, so I think they came out of this year not thinking hey, I got to worry about the cap. I mean, they just did a ton of refinances at the beginning of the year, and they started outpacing, and they were going to run out of their cap business, and kind of the end of the third quarter, start of the fourth quarter. So now it's starting to hit the brakes on waivers and things like that on the cap business. So you need to go uncapped to really kind of be in it. So if you're looking at deals in particular in the workforce space, if they can't go green or they don't have an affordable component, you're not going to get the same spread. So you need to make sure. Fortunately, most of the deals in kind of the workforce certainly can fit in the uncapped business, either green or affordable. What's really going to be impacted, all these deals kind of coming out of lease up, the new construction stuff, those are the ones we kind of thread the needle on the one we bought, because we got really attractive pricing waivers and stuff like that. So I think that's really kind of what I'm seeing, Paul.
Give me some pro tips. When you get to be the size that you guys have gotten to, what are some pro tips that people who are just starting out or haven't invested in their first deal to where you guys are at right now? Tell us a little bit about that.
Yeah, so I always say it's unfair business, right? So the more you do, the better terms and things you get thrown at you. So we actually had the head of all production for Freddie Mac come to reach out to us and come to our office and kind of pitch us to do more business with Freddie, because we've historically done a ton of stuff with Fannie. Because when you first started out, certainly when we first started out 6 years ago, Freddie didn't want to touch you unless you had a lot of experience. And now they got their SBL program, which we had a recent podcast on. So they're kind of getting a little bit more into that game. So I think they're changing their tune a little bit from when I started. But, we kind of stuck with Fannie because that's what we've known predominantly, even though we've done, I think, 4 Freddie loans. Well, so they were, pitching us hard. So we've been able to get some pretty good spread. So what I've been kind of thinking about.
Spreads, what is that?
So when you get a loan, you have your base plus a spread. So the base, if it's fixed rates, typically a 10-year treasury plus a spread. So if the 10-year treasury is at, what's 10-year treasury at? 250, let's call it, somewhere around there. And you have a 200 basis point spread, it means your note rate would be 4.5. So the spread plus the index, that'd be fixed. Or if it's a floater, it's typically 30-day LIBOR plus a spread. So 30-day LIBOR is almost 250 as well. I mean, so if you get we just got a deal at a 156 spread over the 30-day LIBOR. So that's like, a low 4 rate basically. And so one of the things we did is we had an option. So we wanted to go floater because this is a deal that typically it's a 1-year lockout and then you have a 1-year prepay thereafter. So I can't pay it off for a year, but then after that, if I want to pay it off, it's a 1-year lockout. Then if I refi into a fix, they'll waive the one exit fee. Well, we were in our meeting, the head of production was saying, well, if you agree to a 2-year lockout, we'll tend to come in on the spread a little bit. Or if you agree instead of a one exit, you go to a 3-2-1 step down, we'll lower our spread a little bit. So what we ended up doing is we got 2 quotes. One was a 156 and one was a 166 spread over LIBOR. And it's really 1-year lockout, a 2-year lockout. So we knew we were going to be in it for at least 2 years. So why not just take the 10 bip lower spread? And that's kind of what we agreed to. So when you're negotiating some of this stuff, if in particular, if you're on a floating rate basis, so an adjustable rate loan, if you're willing to do something like either a higher, like a step down prepay, or a longer lockout period, they guarantee that income stream a little bit longer. So they're willing to come in a little bit on the spread. So that's some of the stuff that we just recently were successful doing, Paul.
Another pro tip, what's going on with property taxes and insurance these days?
Yeah, we should probably talk on a separate podcast about that because they're both very challenging. So just be careful when you're underwriting. Maybe we'll do a separate podcast on that because I don't want to go too long and I could talk forever about that right now. This is some of my least favorite times of the year because property taxes in Texas come out in like mid-April and my insurance comes up in mid-May. So it's always a 1-2 sucker punch here the last several years with increases.
All right, maybe next month we'll talk a little bit about some of the expenses on an income statement to kind of see what that's all about.
Yeah, so just a couple other just pro tips. So just think through stuff like that. I mean, I think you can, if you're willing to take a little longer lockout on a floater, or if you're willing to take a little alternative prepay option, I think you get down on your spread a little bit. That's really it. I mean, the market's pretty hot. Just pay attention to stuff like that. I think getting, someone with a lot of experience like Paul or one of the old capital guys on your side, they can kind of help navigate it. So maybe this little talk will prompt you to start playing 20 questions with Paul when you're structuring a deal to think out of the box a little bit and see if you're going to be in this deal for a certain period of time, but you want to have flexibility after the certain period of time. Maybe there's something we can do to tighten it up and get a little better result for you.
Sounds good. Tell me a little bit more about what SPI does in your company, Michael.
Yeah, really. So the best way, first off, to find more information about what we do, if you're interested in learning a little bit more about or potentially investing with us, is simply go to the company's website. which is www.spiadvisory.com. That's SPI, like spy, advisory.com. There's a contact us form. Fill that out. And I'm always happy to have a 10 to 15 minute call with listeners of the podcast. But, really what we focus on, and the majority of what we want to do the rest of the year, is just focusing on, identifying high quality deals, tying them up, and then going out and raising capital from just high net worth individuals we have relationships with.
You don't do other property types like self-storage or office or retail. You guys just only do multifamily. Is that right?
I do suburban multifamily, Dallas-Fort Worth, Austin. We have a few deals out in Tyler, but that's kind of what we focus on, just Dallas-Fort Worth, Austin, suburban, A- multifamily.
And is that a good market in Texas, would you think?
In my opinion, these are the two best markets in Texas, and certainly amongst the two best markets in the entire country. So there's lots of good markets out there, but I challenge you to find ones with better demographic growth and economic and business and landlord environment than Austin and Dallas.
Sounds great. All right. I'm Paul Peebles. That was Michael Becker. Have a good day.